Greetings my YouTube family, thank you so much for visiting this channel. I am so excited that you have visited this channel. But for those who are new, my name is Isaac Jonas. I founded Streetwise Economics to share my investing and personal finance journey. I am a trained economist, but what I like to do the most is to just share my insights, but not as investment advice, but just my experiences. I am very much aware that investing is very personal. You should always do your due diligence and invest your money in things that you understand. So this is not to say what I do and how I invest is what you should do. But today, I like to just share with you the major economic updates that happened in the US. But I'm going to just quickly summarize, but I'll put this on the screen here so that you can see. But I'm going to just quickly touch on the major economic highlights, and also for next week, what are the major things that I will be looking at, so that at least I focus on sharing with you what I think. But what I liked and the major highlight is that the Toronto Stock Exchange, it closed up 0.35%, whilst the Standard & Poor is measured by the SPX index, that is the ticker name, it closed 0.25%. But it was very volatile, it was wild. On Wednesday, it rallied towards around past 3 p.m. right? But it was just trading around, a certain region. But these things happen in the market. The Nasdaq, it closed the week minus 0.05% down. Now, there were major economic updates like the GDP number. It was released on Thursday, March 28th, and it was 3.4%. And analysts we are anticipating that it was going to be 3.2%. And also the initial jobless claim, there were less people who filed for the unemployment claims. That is 210,000 versus 212,000 that was anticipated. And the core CPI price index for month on month, it was 0.3%. In other words, it was 0.3% higher than last month of January, because it's a lagged indicator. But also for the year, the core CPI index year on year, it was 2.8% versus 2.8%, which was expected. So there was no variance here. The analysts were accurate. But in January, the core CPI, in other words, inflation, it was 2.9%. What this means is that inflation actually, in a way, I think it has not been dropping as much as most analysts, and including even the Fed. The Fed chair spoke on Friday, today actually, and he was very clear that the Fed is not going to quickly cut the rates, because until they see that inflation has dropped to the benchmark of 2%. So what this means is that analysts have been hoping that inflation is going to drop, or the Feds are going to decrease the interest rate. So what I like to do when I'm investing, I don't want to think to think to myself that I can predict the direction of the market. The market can go any direction. People can just wake up, they freak out, they start selling. So like I said in my past videos, I like to always have at least 20% of our family portfolio in cash. That way I can take advantage if the market drops. If it goes up, the money that is in the stock market, in the equities market and other securities, it keeps on increasing. So that way I can have cash and other fixed income, like money in the checking account for the basic needs. Now, I will also say that if the market drops, it is very important to also have consider other options. Like in my case, I like to buy, I've said this, the exchange traded funds that track the volatility of the market. Usually when the market drops, the VIX like VXY, that exchange traded fund, if I look at the graphs, when the S&P 500 drops, it usually goes up. So that's something that I consider. Some people do bonds, some people have cash, some people they put in treasury bills. And what this means is that I don't put my money in one basket. So I have at least 40% of the family portfolio actually in cash that is just sitting. But I've also been trading options to generate some income. And what this has been doing for me is I've been learning, because what is key is to learn and educate yourself. So that's what I did. I took a course, I learned how to trade options, and right now I also share my insights. I have also a course on my website. You can check it out on Streetwise economics.com. So that's something to consider. I think the most important thing is to understand that investing or even trading is very risky. So I like to take the risk that I can sleep peacefully after making that decision. I don't like to say, oh, everyone is investing in this and investing. I like to understand what I'm putting my money, my hard-earned money on. And I don't like this concept that sometimes you wake up, put your money in this and you're going to make this money. Of course, some people can do that, and that's speculation. But for me, I've seen it again and again. People get bent. Like, for example, right now, there are stocks that are really going up. I stay out of that. I'm not even invested in NVIDIA directly, but when I have the S&P 500 or actually the QQQ, that is the ETF that is listed at the Nasdaq, and it has about 100 of the tech stocks actually. And also I have another ETF called SOXL. It has NVIDIA and other semiconductor businesses in that sector. It means I have exposure to that, but it's not 100%. It's maybe 10%, 5%. So if it drops or if it goes up, I'm still going to have that exposure. That's me. I'm being conservative. I have learned that it's very hard to even beat the S&P 500, which has historically returned 10% over the past couple of years. It was, I think, started trading in 1928, but also we see that the data is mostly available from 1928 to now. It is a lot of data points, and historically some years it goes up, some years it goes down. But the key is that I like to stay invested. If the S&P 500 drops, the money that I have, I keep on adding some shares, right, in those ETFs and high quality businesses that have good earnings, that are profitable. I don't like to invest in speculative stocks. I like to do so. Maybe I will put maybe less than 5% in one speculative stock. For example, it's not investment advice. I opened a position in Palantir, but it's kind of like in my margin account, and I kind of like take some risk bets. In that case, like maybe if I make a profit as I'm trading options, I make $400-500, I cash out, right? But for my long-term focused portfolio, I don't even look at them. And that's where I buy the S&P 500 index in terms of the exchange traded funds that trade them. It's not investment advice. High quality companies like Microsoft, Amazon, only when they drop to a certain level, right? And when everyone is selling them. So that's why I keep some cash. And that's my policy. That's what works for me, right? And that's what I like to do. And I like to say, if the market drops, I'm comfortable. I have other securities. Some people, they invest in gold. Some people invest in bonds. That's the traditional approach. And it is called, I think, capital asset theory. And what usually happens is, it has been studied that again and again, mostly when the equities drop, a lot of people, they go to bonds, because bonds, they are less volatile. So depending on someone's age, sometimes it makes sense to have, sometimes people say you just subtract your, I think your age, to say if you are 100 years, you subtract, if you are 40 years, you say, okay, I will put 40% in equities, the 40% in bonds. The reason why people do that is that sometimes the market can drop for 3, 4, 5 years, right? It happened around in the 1930s, I think, during the Great Depression in Japan. It was down for many years. So let's say if you've retired and the market drops 20-30% and it drops, sometimes it can potentially drop at minus 47%. It has happened, right, in the past in the US. So those are some of the things I like to learn from history. So that's the reason why I like to keep some cash. It's a bit crazy in a way to say you can have, cash that can cover your monthly living expenses for 2-3 years. But that's something that I like to do, because let's say the market drops like 40-50%. Am I going to be comfortable? Yes, because I will have some my living expenses, because you can lose your job, the market can drop. But during that time, the most important and interesting and exciting time is that I will be buying at the very, like at that point, because what's happening is that if it goes 40-50%, it is the S&P 500. Historically, it has come up, right? It has gone up. But a lot of people, they sell, and when it's like right now it's all-time high, people start to want to buy. So it's the opposite of making money. You buy high, you sell low. Anyway, please, if you haven't subscribed, click that subscribe button and smart subscribe so that you don't miss content like this in the future. Thank you again for your support, and have a wonderful week ahead, and may the markets be with you. Bye bye for now, and enjoy the Easter holidays.